Welcome to Nasdaq Trade Talks, where we meet the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Andrew Krei, Co-CIO of Crescent Grove Advisors, Katie Self, Investment Manager, Global Environmental Opportunities at Pictet Asset Management, Michael Normyle, U.S. Economist at Nasdaq, and Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk. We're here to discuss why the bond market continues to play a huge role in stock market performance and what thematic investing is and how it fits within a portfolio. It is great to have everyone here with us this week. And of course, Andrew, the stories around what's happening with data and how it's kind of, making it a little bit harder for the Fed.
Well, yeah, it's a mixed picture, right? I mean, you had this spike up in the inflation data, certainly over the last couple months, that changed the rhetoric. We went from talking about cuts and coming into the year, 6-7 cuts priced into the markets in the forward curve, and now all of a sudden they had to go this kind of higher for longer posture. Now we get the data today suggesting that perhaps there's going to be a little bit of scope for them to start talking about cuts again, right? That we came in kind of in line from a CPI perspective. We didn't get that hot print that some people were afraid of. And then you get the retail sales number that suggests that perhaps we're seeing a little bit of cooling with the consumer, all pointing towards, again, scope for the Fed to perhaps at least start talking about cuts, right? Perhaps it's not the next meeting or even, you look out to September, let's say, perhaps is the kind of where they could circle and say, maybe we act, based on the fact that things continue to cool and move in the direction that we want them to move.
Yeah, and Michael, what's your take on this? In terms of what's happening with the rhetoric that the Fed is putting out or not putting out, or how clear their messaging is. What are your thoughts around the data?
Well, I think Chair Powell yesterday, he took kind of an even-handed approach to the producer price inflation we got the day before, which he called mixed, which I think was the kind of nice way to look at it because the headline number was higher than expected, but the pieces that flow into the PCE inflation, which is the Fed's target, is based on that, were more, weren't quite as high. So there was kind of an optimistic view to be taken there. And then today, of course, with the CPI data, it feels like first time in a long time where it's not been higher than expected, and only kind of just barely where we had, month on month, headline was up 0.3% instead of 0.4%. But you do get some good signs in there. Primary rent increased at its slowest pace in 31 months, and housing is really one of the big factors that's been holding up inflation at this point. So we need to see a lot of the kind of disinflation that's still in the pipeline in housing to come through to bring inflation lower. But finally, after Q1 was bumpy, like you were saying, got a little bit better inflation data today.
And Kate, as an international manager, what is your perspective on the macro environment here in the U.S.?
So, well, particularly as a thematic investor, and we look, it's kind of different because we look very much over the long term. And the idea with thematic investing is that you're looking to capitalize on secular megatrends that play out over decades rather than over quarters. But that said, the macro has an influence. Of course, it has an influence in the shorter term. And for us, I mean, we're actually particularly positive on the US at the moment because much as there's constant back and forth and rhetoric around rates, around elections, and around a lot of noise, actually the investment landscape here we see as being one of the most favorable globally, and certainly amongst the most favorable that's been really in modern history.
Yeah, and we're going to get into some of your themes in just a moment here, but Max, I want to take a look at the housing market for a minute again too, because that really seems to be, housing, rents, and insurance really seem to be the sticking point here as it relates to inflation. And I think from a consumer perspective, as you think about going to the election cycle, this is how consumers and the average person trying to pay their mortgage, this is how they're perceiving the economy.
Yeah, housing, this is an interesting one. So this is comparing the home builders to actually prospective buyers that are out looking for a home. Home builders have, obviously, we've talked about frequently, the home builders have skyrocketed. They're trading really well. Prospective home buyers have really fallen on a quarterly basis here. Now, is that a fixture of lack of supply, so they're just not going out there and where the home builders will actually help it, or the home builders building a ton of supply that there's not really going to be that much demand for? Obviously, we've been talking about there's really limited supply, or supply at the right price has been kind of a key one. We've talked about in certain markets, down in Florida, some in Texas, out in the West, there's a ton of supply, but the numbers that sellers are asking for are super high. They're comfortable sitting and waiting there because they have a mortgage at sub 3%. They don't need to sell it. There's no forced selling to drive those prices down. So they're sitting there waiting. So yeah, there might be supply, but it's not at the right price. So potentially this is a good sign with the home builders building a ton of supply, potentially driving some of those costs down. If you have additional supply, people can come in and get it. But the amount of people that have actually gone out looking, interested to buy it has fallen, which is a bit worrisome for that space in general if they don't start to pick up once that new supply really comes online. So again, hopefully with this additional supply with the home builders really getting out there, you're going to see prices drop. Again, how quickly you'll see that, it's a lagged effect, so it'll take a while for that to really bleed through. How much the Fed is going to weigh into that, where they say, okay, we understand it's lagged, but when that was really driving things, they kind of looked at it at a real-time basis. So interested to see how that plays out. But again, rates are where they are.
I would agree with you. And Andrew, whether we get 25, 50, 75 basis points, it's not necessarily going to move the needle in terms of affordability. And I think everyone's starting to recognize we're not going to see the rates that we saw at the end of 2020 and 2021 and resetting those expectations. Because when you look at it historically, these are pretty decent rates. It's just for 10 to 15 years we lived with so much liquidity and so such low rates. But it's interesting. You noted that the bond market continues to play a really big role in stock market performance. Explain what you mean by that.
Yeah, so we kind of talked about this idea of the Fed can start talking about cuts again potentially. But if you look back over the last, call it 18, even going into 2022, call it 24 plus months time frame, anytime there's been sort of a disorderly period within bond markets, if you look at the MOVE index, right, the volatility of fixed income markets, that's had a pretty negative correlation with equity markets in the sense that you start to see bond vol tick up, that often accompanies rates rising. You saw equity markets trade off, or at least have some sort of indigestion. So we think that you're kind of in these mini cycles right now where you get the Fed, taking a more dovish tact, then flipping back to the more higher for longer tact, and then back to the dovish tact, which is really, I think in many respects, dictating that short-term, call it 3 to 6 month performance for stocks. Right now, we think this has the potential for an appreciation period for risk assets as we get into a little bit more of a Goldilocks type phase where the Fed can tip back towards being a bit more dovish, again, because the data readouts perhaps are softening a little bit relative to what we saw earlier in the year.
Yeah, well, I mean, we have to think about it too. Should you get those 6, 7, 8 rate cuts, we have a bigger problem than just rate cuts, because there's obviously something wrong with the economy here. But Kate, let's talk about some of the themes that has you bullish longer term. What's happening here in the U.S. that you're looking at?
Yeah. So the reason I mentioned particularly bullish on the U.S., it's about the investment backdrop, the amount of funding that we're seeing that's going into infrastructure, new buildings, new manufacturing capacities, that's really coming all at one go in the US. And so for me, you mentioned I'm managing on the global environmental opportunities strategy, and it's one of the reasons that we're quite heavily positioned in the US, because this kind of confluence of reshoring, of increasing electrification, we're trying to plug in REVs, we're trying to plug in heat pumps in buildings, et cetera, and at the same time you have an absolute boom in data demand.
Right.
Those three things together are really driving an inflection in electricity demand that we haven't seen for decades in the US. The same is true in Europe, but the absolute dollar amount is a lot higher than what we're seeing in the US. And so that's one of the trends where for companies that are providing the solutions, energy efficiency, power management for buildings, resource efficiency for things like data centers that are going up, semis, fabs, the companies that are supplying the real efficient tools for those types of projects, I think we're going to see really boom over the coming years.
Which is so interesting, because wasn't utilities the top performing sector?
One of, and it's funny, we've had that conversation here about this kind of now. We've had that bit mega trend in AI recently, and it's really been focused on the chips. And now we're starting to get that second and third order of who else is going to benefit from it. And we've talked about it countless times here on Desk. The energy demand for those data centers to run all these AI-powered products is going to be massive, and it's going to need to be built out. So again, that first trade was the chips. That's the most obvious. Who's developing it? Who's building it out? They're the first winners. But now that second and third, starting to see a bit more of that rotation into those second and third orders of, okay, wait a second, they're also going to be starting to benefit from this, whether it's through efficiencies, in their productivity as a company, or you're actually directly involved in essentially the AI stack. You're starting to see that outperformance start to pick up finally.
Yeah, and now what else? I'm sorry.
If I could just add on top of that, because I think the utilities point is so interesting, because obviously just at the end of last year, if you look across US utilities, they revised up their CapEx budgets 20% on average, and we haven't seen that for a very, very long time. 40% are some of the largest names, and that is because of all these different driving factors. As you say, AI been a huge one. On top of that, the reshoring, the manufacturing renaissance, it's really stressing the grid.
I would also argue that's the reason why we're seeing that rotation into energy as well, right? Because it's not, I don't think it's going to be one thing where electricity is the one-size-fits-all solution, right? It's going to be a portfolio of different types of energy, and I think that's why you're seeing that rotation, at least in the interim, as we figure out what the renewable energy landscape looks like. But it's so interesting when it comes back, and I feel like everything comes back to the AI conversation. It could be used for really good things. It could be used for really bad things. It is a big energy consumer, but then what does that look like as you start to think about renewable opportunities and almost driving an electric car? Why can't it just continue to energize itself? I mean, I don't know anything about automobiles, but I just think we're at such an early stage of it, and it's not really the stocks that have the exposure to the technology, but the stocks that have the exposure to power it, public and private. For sure.
Yeah, absolutely. And the AI, this is a general purpose technology, right? That's going to be used in countless different ways, in unimaginable ways that we can't think of right now. But what we do know needs to happen is the construction of data centers, the construction of semis fabs. And these are power hungry, water hungry, et cetera. So there's a lot of different companies and solutions that will go into those projects.
Yeah, and it's interesting, Andrew, because you're actually seeing opportunities in international regions.
Yeah, we just think from a relative value perspective, versus kind of the mega cap tech leadership, which has continued to do so well even into this year. Call it 2 times the S&P 500 performance for the Mag 7 to start this year. We just think that there's going to be scope for a relative value rotation at some point here as we see data start to inflect higher. So if you look at manufacturing PMI data, you look at export data from Japan, Europe, Taiwan, Korea, some of these more cyclically oriented type of economies. It's not great in absolute terms, but it's starting to inflect higher. So we think that if you kind of put this in a historical perspective, what time is best to own these types of assets that tend to have a little bit more cyclicality to them, it's coming out of that trough. And if we think, again, there's going to be a firming of global growth, that's going to present an opportunity for a re-rating of these stocks, which are again, relatively cheap versus US markets. So all in all, we think maybe you take some chips off the table in the things that have done so well, and then look at some things that have been a bit depressed or a bit, sort of that catch-up trade concept, let's call it.
And Michael, now that we're somewhat out of earnings season here, did you see broadening out in terms of earnings performance when you reflect back on the season?
Well, I think what we really saw, and maybe it's not even the broadness of it. I think it is looking at those top companies. The kind of Fab 5 was a big way to split things up instead of the Mag 7, right? We've shrunk it to the Fab 5. And if you're looking at their earnings, it was 80% year over year for the Fab 5, and the rest of the S&P 500 was slightly negative. So I think the broadening hasn't happened. I mean, maybe it's unfair to just look at 5 versus 495, but over the course of the year, that's where you see that kind of broadening out, where it's kind of the Fab 5 returning to a more normal level, and the rest of the S&P 500 also, but from the downside for the rest of the S&P 500 and from the upside for the mega caps.
Yeah. Well, let's take a look at that chart, Max. Russell 2000 versus S&P 500, because we are starting to talk about where other value is, and the narrative isn't just about potentially lowering rates.
Yeah, we've been kind of waiting for this one to close the gap here. We saw at the end of last year, when the 6 cuts from the Fed were really priced in, you saw just a real tailwind for some of the small caps. It actually turned positive. They outperformed to end December, and then it got as low as basically 11% underperformance in mid-April when we sold off. We're starting to close that gap again now. We're at about 9% of unemployment or underperformance from the Russell versus the S&P. And here's another chart of Russell bumping up against 52-week highs again. And once you clear that, you still have about another 11-12% before you get back to all-time highs, which we saw in late 2021. So there's room to run if we get through that. So again, I think the setup for the small caps is there. Again, we're starting to get more normalcy from the Fed. The 2% it's less volatility for them, and that's really what they need. I know we talked about it the other day. I had a call with the company yesterday, 2 days ago, about what they're looking to do in rates. They're going to tap the market, and the story had always been, all right, we're just going short term. Let's make it through, wait for the cuts, and then we'll do something long term. Now they're actually saying, okay, we're actually going to try to lock something in long term, pay off our revolver, get rid of everything short term. We're kind of more comfortable where we are as a company now, and we can model this and understand what it means to be if we're at, call it a 6 or 7% rate on their note. They're comfortable with it in how they're performing, and they're not worried that we're going to see this big volatility to the downside. Like, oh, if we put something on, it's going to move and be at 1.5% for the Fed funds rate, and we made a big mistake. So again, the lack of changes there are getting more reassuring for them. And again, you're seeing that tailwind for them, that they're more confident in what they're seeing in the market. They're going out and tapping the markets again for the debt market, and they're looking for more upside.
Yeah, I mean, certainly the market seems to be reflecting that as well. I mean, we did, the narrative at the end of last year was 6, 7 rate cuts didn't happen. We might get 1 or 2 this year, and it feels as if it's more fundamentally basis movement that we've seen than necessarily just relying on what the Fed is doing. I think that's encouraging. I mean, we're what, near all-time highs, if not there already?
Yeah, I mean, I think you look at kind of what we've seen in terms of the scope for re-rating this year at the current levels that we're at, from a valuation perspective. It just seems like there's going to be a cap on where the S&P 500 can trade from a PE basis. So earnings really then kind of have to carry the day. And I think we've seen a reasonably good kind of delivery on that in terms of what we've, the news we've gotten over the last few weeks here in Q1 earnings season. So I think for us, that's the big story, is can the fundamentals continue to justify 20 plus times, forward earnings on the S&P 500? And then, are there other opportunities to look at more cheaply valued parts of the world? Again, going back to the conversation about Europe, Japan, Asia ex-China perhaps, or EM Asia ex-China, that to us still looks like an interesting relative value play for some portion of a multi-asset portfolio.
Yeah, and anything else from the thematic side that we should be paying attention to, whether here, whether other opportunities in other regions?
Yeah, I mean, we've already touched on a couple of the topics around, this spend in the US, these mega projects, over $1 trillion worth of mega projects that have been announced in the last 2 years. I mean, that's running well ahead of historical levels. So I think that drives a number of different areas of thematic portfolios over the coming years. But the point, because you mentioned earlier things like renewable energy, and I think from the environmental standpoint, the point I'd make is that environmental investing is so much broader than that, because that's somewhere where we see a lot of sentiment move, we see a lot of noise, and we see flipping back and forth on regulation, etc. And while regulation certainly doesn't drive innovation, it's not what has driven renewable energy down the cost curve, it continues to cause noise. But there's huge opportunities in things like climate adaptation, in things like looking at our water systems, making them more resilient, in pollution control. We've seen new data out from the EPA just in the last month. They've now, for the first time, announced a legally enforceable limit on the amount of PFAS pollution. These are sort of forever chemicals, Teflon, etc., in our drinking water. That is going to require billions of investment from utilities in testing, first and foremost, and monitoring, and then eventually in treatment and destruction. So there's a lot of different areas that I think are particularly exciting over the coming years.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.